Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm pleased again to have Nick DeVito, one of the associates and also a CFP on our staff to join us. Thanks again, Nick.
Thanks for having me.
So this is kind of what we did is based on popular demand. We went through AI, and we just had a whole bunch of questions. We had AI produce questions. And when I say popular demand, what I mean by that is that we have had, we kind of track the number of views on the different episodes that we do, and it's remarkable the volume that we get on these types of questions because people ask these questions. And my biggest problem with doing episodes is I can never think of what to talk about. Not that I really need, okay. But this gives me the prompt so we can topics of discussion. So I intentionally, AI gave us 50 questions, and I reorganized them in such a way that made sense to go over it. So what happened is the prior episode, which is the first part in this series, we were talking about effectively the creation of a financial plan. Okay, what goes into it, expenses and things along that nature. How do I track my expenses? And all that. We talked about that and the different financial planning methods, et cetera, in the first episode. As we talked about in the first episode, most people who are doing financial plans really have their goal in mind of retirement. Not everyone. I think people who start financial planning early I applaud them, and that's the first thing I tell them when they call us. It's like, I'm happy to see. We talked to somebody yesterday who was 27. So pleased to see that. But most people that we see really have the goals of retirement first and foremost. And so therefore, it made sense to take what we talked about in the first episode, and now let's apply it to this. So,
to be fair, jumping off that point, those who start earlier tend to have a little bit more flexibility on the back end, and we'll touch a little bit on that starting late versus starting earlier, but we applaud the people that start early because it's such a great thing that they're already thinking about it and already working towards that.
Well, I'll piggyback on that. So I've been doing this for over 25 years now, and I've had the privilege of meeting all kinds of different people during that period. And I've noticed that there's different people have different philosophies at different age groups. Different age demographics. People in their 20s are just sowing their oats and having fun and partying and everything else like that. In their 30s is when they're settling down, starting to have a family. In their 40s is when they're just huckered down, taking kids to softball practice and baseball and band and choir and, soccer and a whole 9 yards, okay? And barely rubbing two nickels together. All of a sudden they're in their 50s and they're like, holy cow, you know what? Start an empty nest. In their 60s is when they're thinking about retiring. And in their 70s is when they kick the kids to the curb and say, just bring on the grandkids. What gets even better than that is that over these 25 years, I've actually had people traveling through each of these demographic age groups. And remarkably, what I have found is kind of like your eyesight goes right when you're 40, or at least you're reading. I've found that it's right around age 60, plus or minus 2, that people begin to get tired and tired of it. And that's the point where they're very anxious to finally hang up their cleats, and they don't want to work anymore. They're tired of working, or worse yet, and I've seen this a lot, is that's the age that people get laid off. And okay, probably shouldn't say this, but age discrimination exists out there even though it's not supposed to, because it's very difficult. You're making good money, get laid off to be able to find another job making that kind of money. So what you do at an earlier age, to your point earlier, what you do at an earlier age is positioning you to be in control when it's time to be 60. It's okay that you continue working, but work when you want to work, not because you have to work. Trust me when I tell you, your attitude going to work every day is a whole lot different when you know that you can walk out because you're financially sound.
Oh yeah, absolutely. And it's one of my favorite parts about this job is being able to tell people that they do have that option now.
It is.
And just seeing, sometimes you'll see the weight lifted off their shoulders. Okay, you know what? I have a different attitude towards work, to your point.
Yeah, and we've had people crying at the end of an appointment because it lifted so much stress and pressure off of them that, It's great.
Yeah.
It's a very fulfilling job. So let's get started. So I reordered the questions that AI produced so that it seemed like a natural format, which the first one is great because it pivots right on from what we talked about. And the first question is, how much money do I need to retire comfortably? And the answer to that is the same 2-word answer to every financial planning question we get, which is?
It depends. So to Mike's point, it really does depend, specifically this question, because going back to the first episode, we talked a lot about goals and prioritizations. And everyone is different from what their goals are, and that could be living quality of life goals, other various retirement goals. So I think in order to know how much you need to have to retire comfortably, it really comes back to, well, how cost of living, I would say, is one of the biggest components of that, because people, when you say comfortably, that means not having to worry about expenses and not having to worry about income. So how much do you need? It depends, and it really, what you want to take a look at is what is your income going to be in retirement? Do you have a pension available to you? What's Social Security looking like? Do you have rental properties, any other income out there? And then taking a look, then you can take a look at your expenses, determine, okay, well, how much am I going to need on an annual basis to live on? How much am I going to want to have for vacation? How much am I going to want to have for other goals you may have? So you have your cost of living, you have what your income is going to be, then it's that question of how much you need to retire comfortably, and that's basically filling that gap. How the comfortability part comes from how much are you going to be drawing from your investment accounts, from your retirement accounts, to fill the gap of your income and expenses. Because if you're, for example, say you have $7,000 a month in income from Social Security and pensions, and your cost of living is $5,000, well, then you don't need anything else. Obviously, it's nice to have and I'm exaggerating when I say that, but it really comes back to your income and expenses and then filling that gap, and that filling of the gap is how much you need.
That's correct, and that's very well put. And the other thing, too, is that how much money you're going to make on your money. So if you have $1 million set aside for retirement, if you're earning 2 or 3% in the bank, that's a whole lot different than if you're earning 8 or 9% in investments. And do not underestimate the impact of rates of return. Now, what's also important to understand, and when you're doing this is an exercise that I really believe you would benefit from working with a professional. Why do I say that? Because professionals have experience doing this, and oftentimes the general public doesn't. They don't realize, oh my goodness, Medicare, then they didn't take that into consideration. They didn't take taxation into consideration, whether it be federal taxation. They don't take RMDs into consideration. There are so many things that having a professional who has experience in it can bring additional light to the table. One of the things that I have found people do not take into consideration is inflation.
Yeah, inflation, to your point, Medicare and IRMA potentially, taxes, some things often get overlooked. And what we'll often find is people that come to us, more of the do-it-yourselfers out there that maybe come to us when they're in their 50s and 60s, they've gotten to a point where they've been able to save a lot of money, and they want that second opinion. They want someone to look at it and say, hey, what are we missing? And obviously, we do this every day, so we're going to catch things that they don't think about, and it's no fault of their own. They were just never taught it. So I think that's the value that we bring to the table, especially when someone's nearing that retirement goal, because the biggest question people often ask is, am I going to be okay? They want to know that they're going to be okay. And I think to your point, coming to us and we can look at it from a different lens, there's no emotional attachment to those savings like they have, and we can really look at it from an unbiased. And obviously, we have access to software programs and things of that nature that we can utilize as well.
Well, and the same with software. Software is a wonderful thing, but you have to understand how it works. And it's only good as the information that you put in it. And if you understand how the program works, then you can kind of circumvent the program when, in fact, you have something that's a little bit of an outlier. And what we do run into a lot is people come to us a little skittish about retiring, because to your point, and how Harvard measured this, I have no idea, but people are more afraid of dying than they are, more afraid of running out of money than they are of dying when they're in retirement.
And it can be difficult. We've worked with people that we've demonstrated to them, you're going to be fine. with the current goals you have, you're far past where you need to be, and they still struggle with it because for a couple reasons. It's a big transition. You've been working your whole life, and now you're suddenly not working. People often feel, oh, well, I don't have a paycheck anymore, so I'm afraid to spend. I'm afraid to do the things I want to do. So I think what we can also provide is some kind of solace in the fact that we're telling you you're okay. We can demonstrate to you that you will be okay, and it's okay that you don't have that paycheck coming in because you have your 401k that you've worked so hard. And that's one thing we always emphasize to people. We want you to enjoy your retirement. You've worked hard your whole life. You have this savings that you've been working on. Use it and enjoy it.
Yeah, and the thing is that people, when they retire, they're like, well, where do I get my money from? And, it's a question I looked ahead and I saw, and we'll talk about that in a little bit later, but, so how much do I need? Again, it depends, and it really varies based upon every individual's specific circumstances, such as specifically how much do they need to live on and what sources of income will they have in retirement.
Yep. And I think this leads, and we kind of already touched on it. The second question was, how do I calculate how much I'll need to save for retirement? Once again, it kind of goes back to analyzing what your income is going to be and your expenses, figuring out what that gap is, and then to Mike's point, you could do it in a spreadsheet if you really wanted to. There's software programs out there that can tell you how much you need to save. It depends on, to Mike's point, rate of return, what you predict inflation to be. So there's not a one-size-fits-all answer to that, but looking at your income and expenses and then figuring out that gap is a great place to start.
All right, I'm going to ask a question that's not even on this list. A lot of people do ask, when should I start thinking about it? Well, obviously you should always start thinking about it well in advance, but I really believe that if you're thinking about hanging up your cleats and retiring, that the ideal time to start really is no less than 3 years beforehand. Because 3 years beforehand gives you the ability that you still have some control over some of the things that you want to do, gives you the ability to practice retirement, gives you the ability to truly track your cost of living. And so we strongly recommend, don't be calling us, I'm thinking of retiring in 2 months, do I have enough? You got to be looking at it a couple of years in advance. Not to mention, we have all kinds of nifty ways of leveraging the tax laws to advance what you want to be able to do to help you accomplish your goals and objectives.
And we talked about earlier, one of the best parts about this job is telling someone they can retire. It's not fun to tell someone you can't with your current goals, or that you have to make sacrifices and adjustments. And to Mike's point, I think getting ahead of that and planning a few years out softens that blow and allows you to change maybe current lifestyle to account for your future goals.
Exactly. And yeah, I hate that conversation, but I'll tell you what, I shoot the messenger, and if you had to shoot the messenger, I wouldn't be here anymore. But it's much better to know beforehand than to retire and find yourself the next question. Amazing. What happens if I don't save enough for retirement?
What happens is you have to adjust, I guess, is what I would say. If you wanted to live on $5,000 a month, but the reality is you can only live on $3,000 a month, you're going to have to make sacrifices. There's not necessarily going to be a guardian angel out there that swoops in and says, oh, you know what, you didn't save enough, but here's $1,000 a month. So it really comes down to, you'd have to just adjust your expectations and what your goals are. You might not be able to go on as many vacations as you wanted to. You might not be able to do some of the things you wanted to if you don't save enough. The onus is going to be on you to make those sacrifices.
And I've seen people going back to work at the age of 75 and 80 years old.
Yeah.
It's not what you really want to be doing, and you know that you're not going to be making a whole lot of money. So again, it all comes down to planning. Nobody plans to fail, they just fail to plan. The next question was, how can I catch up on retirement savings if I started late? I'll take that one. First of all, you got to put your nose to the grindstone and be aggressive with saving. Now, the other thing too is that there are a variety of tax law changes that enable you to save more. One, they have the catch-up contributions for IRAs. You can contribute an extra $1,000, which is chump change. You can contribute, it's an extra $7,500, I think it is.
Yes.
In a 401k, you can contribute an extra $7,500.
There's even they just added a super catch-up provision to the 401ks, which now for ages 60 through 63, I believe.
Yes.
You can there's an additional catch-up on top of the original $7,500 catch-up. So there is built-in ways that allow you to catch up. It's not, you can do it, but to Mike's point, it's really about, it sounds like a broken record, prioritization. And if you realize you're behind on your retirement savings, maybe you cut back on other expenses so you can drive more into your 401k, so you can drive more into your IRA, so you can drive more into your investment account.
So, when it really comes down to it all comes down to prioritization. If you don't have enough money, it forces you to be making some decisions. You're either going to have to bite the bullet and reduce your expenses and save more, or you're going to have to spend less in retirement, or you're going to have to work in retirement, or very simply, you're going to have to work longer until you can retire. And we've seen all of those. And those people that we see who are experiencing that would not be in that position if we saw them 5 or 10 years earlier, or at least would be in a whole lot better position. And I just take a look at some of the successes that we've seen from people who had hardly anything at age 56, 57. They might have $20,000 all in on all of the retirement and savings and stuff like that. And we just played some magic, and all of a sudden they're 65 years old and they got like 400 grand in the retirement plans and everything else like that, because we can guide them to doing nifty things. And even if it's just making adjustments, pay off this and pay off that, take the money, drive it to your 401k. There's just so many different cool things that you could possibly do, and that's again one of the advantages of potentially working with a professional.
Yeah, and one last thing on that is the amount of times people have come into us and said echoed that exact sentiment of, I wish I saw you 5 years ago.
Yeah, right.
There's nothing you can do about it. All you can do is move forward, but really thinking about it earlier is always going to benefit in the long run.
Exactly. So we're at a good breaking point right now. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're continuing on with the retirement planning component. And what we talked about in the first segment is how much do I need, et cetera, et cetera. Now let's take a look. Once you've crossed over the threshold and now you're in retirement, or actually this one isn't, this is a savings question. It asks the question of what's the difference between a traditional 401k and a Roth 401k. Before I hand that over for a brief response, we have had so many episodes just on this, okay? And we talk about this in almost any episode that we're talking, this is an important question. And Nick, I'm going to steal it from you. What you need to do is take a look at what your tax bracket is today and what your tax bracket is later to determine which one's better.
And just to jump off that, just to give a quick synopsis of what it is. Traditional 401k, when you make a contribution to it, you're getting a tax deduction now for it. You make $50,000, you contribute $10,000 to your traditional 401k, you're going to get a W-2 at the end of the year that says you made $40,000. As that grows over the years, you're not paying any tax on it. When you take that money out, say your 10 grand grew to 50 grand, you take that 50 grand out, you're paying tax on the whole 50 grand as if you made it.
Right.
A Roth 401k is the flip side of that. So same example, you make $50,000, you contribute $10,000 to your Roth 401k, you're not getting a tax deduction on it, meaning you're paying the tax now. It's growing tax deferred, so you're not paying tax on it as it's growing. When you take it out, it comes out tax free.
My two favorite words.
Yeah, so to Mike's point, if you look at any of our previous tax planning episodes, some of our case studies, we've talked about it, so we don't want to talk too much about it,
right.
But just to give you a brief overview of what it is.
Exactly. Not only that, we have episodes on just that and which one's better. The next question was, when should I start taking Social Security? I'll do that one as well. Boy, that one depends. And we run into this all the time. It's a great, great question because it depends on what your circumstances are. Are you married? Are you divorced? Are you widowed? Do you have enough to qualify for Social Security? If you are married, who's older, who's younger, who has the higher benefit? We have episodes, and I think we did this twice. I did this a few years ago. I believe we did it as recent as last year.
It was within the past few months you did.
All right.
I believe
So
Social
Security benefits are a tremendous opportunity to generate income during the course of retirement. But I'll tell you what, on the government's dollar, there's a way to maximize efficiency. And so, when do I start? I would defer you to those other episodes, or, it's a great question to ask your financial advisor, because it's an important topic. So we're going to leave that one alone because, like I said, we did 2 episodes just to answer that question. So next question. What is a pension, and should I rely on it for retirement? You want to take that one?
Yeah, so a pension is a defined stream of income in retirement at its base level. So, and whether or not you should rely on it, well, that depends if you have it available to you. Your pensions are rare nowadays. Back in the day, they used to be a lot more common, and they were offered. Now you don't tend to see them as much. So essentially what it was is all these years, a company or you was setting aside money and putting it into a pot. When you then go into retirement and you determine that you're going to collect the pension, they're going to pay you. You have a couple options. You can either take the lump sum amount of it, so they can say, okay, well, over these years you accumulated $500,000 in your pension. We're going to give you that. Or you can have X amount of dollars a month for the rest of your life. There's different options associated with pensions. You can take the max benefit. Say the max benefit's $3,000, meaning you're going to get $3,000 for the rest of your life. The option could be 75% survivorship, meaning if you were to pass away, your spouse gets 75% of what your benefit was. 50% survivorship, same thing. Obviously, as you go down that list, your monthly benefit is going to be reduced. But at the base level, a pension is a defined stream of income for the rest of your life.
Right. And so people are going to say, well, what if the company goes under? There are situations, what's called the Pension Benefit Guarantee Corporation, which is PBGC. It is all companies that have a pension pay into it. It's like an insurance policy. And if your company goes under, like Bethlehem Steel or whatever, what happens is that the PBGC picks up, and it's usually a reduced amount. But typically, once the pension starts, it usually doesn't get impacted. And it's also important to know that most pensions do not have a cost of living adjustment. Government pensions, which, by the way, Social Security to a great extent is like a pension. Okay, you were paying into it all these years, and you're getting it when you retire. So that's as close to a pension as you could possibly get. So, again, they're few and far between.
And one more thing on pensions. Generally speaking, most, if not all, pensions are going to be completely taxable to you. So when you're receiving a pension in retirement, it's going to be taxable income to you.
Right. Correct. And then the last question is, what is the rule of thumb for a withdrawal rate in retirement? Is it, in parentheses, the 4% rule? Well, you know what? It was back in the 90s. I think it was Morgan Stanley, whoever, it doesn't really matter, had done some type of modeling that said the 4% rule applies that, if you have $100,000, that you can withdraw 4% from that. And then next year, that 4% is inflated to 4% plus 3% of 4% is 4,120. And then the following year is 3% more than 4,120. And that's the number that will run you through. So I don't entirely like that. I actually view the 4% rule. I use it as a rule of thumb. But part of the reason why I use it as a rule of thumb is because, generally speaking, if you can live off of 4% of your investment, you're probably going to be okay, because the odds are you can earn better than 4%. That's number one. Number two, I like to use the 4% growth rate because of the fact that, particularly for IRAs, because when someone retires and they reach the age of required minimum distributions, which is RMD, miraculously, guess how much they have to take out?
4%.
About 4%. What are the odds? Okay,
Yeah.
It's age-based. But if you're 73 years old, it's 4%. Okay, now granted, when you're 80, it's 5%. It's based on your age. But, that's the 4% rule. They say that you can live off a pot of money 4% in perpetuity, and that it'll last you through retirement. Again, that's, depends on, if you get whipped in your investments, then 4% isn't going to happen. If you do significantly better than 4 or 5% in your investments, well then, so I don't like the rule of thumb as much. I would rather go into doing the financial plan. And the last question that was asked was, I love this. How do I know if I'm ready to work with a financial advisor? Of course, we got to give ourselves a plug here. But, how do you know? I mean, you don't know what you don't know. Is what I've worked with a lot of do-it-yourselfers who are really sharp. But it's remarkable what they don't know. And, just getting a second opinion. I've always been a fan of two heads are better than one. I am not here to take away from the do-it-yourselfers, because usually the do-it-yourselfers are researching things and everything else like that. But the practicality of the matter is that, they'll research on the internet. We were working with a client couple who are CPAs, and remember this was about a week ago. And a question came up, and they looked it up on the internet, and it gave them a bad answer.
Yeah.
And I was like,
and it was a tax question for.
It was that's what I wanted. It was a tax question. Two CPAs married to each other. A tax question came up, and they said to us, "We can't do that because of this." I immediately froze, and I'm like, "I don't think it's that way." And they said, "Well, we looked it up on the internet." And so, needless to say, I go hollering out in the hall. Nick comes walking in and said, "It better work because I just did it."
Yeah.
And so he looked it up on the internet and saw it, and lo and behold, we confirmed with the accountant, who does this routinely, that no, yes, you can do it. So where we're going, obviously, if you read it on the internet, it must be true.
Exactly.
But in reality is if you read it on the internet, it may not be true. And in fact, the other thing that you find about the internet is, I know it's caught me off guard. I've looked at something, and then I went back and realized it was dated. I looked back at the article and realized it was dated from like 6 or 7 years ago, and the law's changed since then. Or it's misinterpreting what somebody is saying, or the author of the article that you're reading misinterpreted as well. Mm-hmm. So there's a lot of reasons. So the other thing a financial advisor provides is something you mentioned earlier. Don't remember if it was in the previous episode or this one, but I tell my clients this all the time, is that I got one giant advantage over you. And they're like, "Whoa, you know more?" I'm like, no. We're not emotionally attached to the decisions, okay? Emotions can get in the way of doing a sound decision. And I'm not saying that I don't care. It's just that I'm not clouded by the emotion in the same manner as the client may be. So seeking a financial advisor, we encourage it, okay? We encourage it because, we have the full spectrum. We have people who call us, ask us questions. Hey, we get a lot of inquiries through our website, through these podcasts, etc. We get a lot of them. If I can answer your question on the phone, terrific, okay? Oftentimes people come in and want to sit down with us, and we'll spend 10, 20 hours doing a comprehensive financial analysis and teach them the world of finance as it directly applies to them so that they can make educated decisions on a move forward basis. And this is even with the do-it-yourselfers. We're working with them,
yeah.
Okay? And then there are others who say, "You know what? Here, take it over." But even then, we're a little cautious, because what I say to every single client sitting across the table, even though they want to basically hand it off to us, I say, "Great, except this is a team project. And that whatever we do, we're going to do, but we're going to do it together, because we want to find out, does this meet your goals and objectives? Do you feel comfortable or not comfortable with this particular recommendation?" So, much like I always say that CPAs and accountants are worth their weight in gold, I personally think that a good financial advisor is also worth their weight in gold. And then the amount that you utilize them is entirely up to you.
Yeah, and I kind of mentioned this earlier. I would say that the two circumstances in which we'll see the do-it-yourselfers come to us, one, maybe they're thinking about retirement, want that second opinion of, can I do it? I know I've saved all this money. I know I've been diligent about saving. What will this actually look like? Can I do it? And the second is sometimes just, I don't want to do it anymore.
Right.
I've been doing it my whole life. I want to retire. I don't have to worry about this anymore. So it really varies for everyone, but getting that second opinion, that unemotional opinion on your finances is always key.
I had another client, very sophisticated. It's our biggest client. I don't even know if you know the story. And they're working with us because he said, you know what? All these years I've been doing everything myself. My neighbor just died at the age of like 55, 54, 55. And basically it was his age at the time. Mm-hmm. And he said, you know what? If that were to happen to me, I want to make sure that my wife doesn't have to worry about it and she's taken care of. And we see that a lot. We see all kinds of different reasons, but again, we still think that and you can clarify it, because there's a lot of people out there who call themselves financial advisors who are nothing more than glorified salesmen of crummy financial products. I'll leave it at that.
Yep.
So anyway, thank you very much for joining us. And what's our next episode going to be on? We're going to be talking about debt management, and then we're going to be moving into other areas. So this is going to be a series. And so this is the second part of a series of episodes. So thank you very much. Thank you, Nick.
Thanks for having me.
And thank you very much for joining us. I hope you learned something. I was provoked some things to think about. You have a wonderful day and a wonderful week. Thank you.